When you partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron.
Hello and welcome to Moving Iron Podcast. Marcus Shawn Hackett. This edition is a special one because Shawn's going to talk about the report that came out, the July WASDE report that came out, and all the good stuff that came from that. So, Shawn, looking at the numbers that you had seen so far today, what are your thoughts there and any big surprises?
The soybeans were really the big surprise, the big mover for the day. I think corn and wheat primarily are just following the soybean market down today. When we had that acreage number come out, 4 million acres below expectation, everyone was dialing in a dramatic reduction in future ending stocks. They were, many were calling for sub 200 million bushel carry out for soybeans. Most were looking for some reduction in yield. And instead, the USDA came in with a slight increase in yield, and they substantially lowered exports. So when you run those numbers through, even with the 4 million acres reduction, they only moved ending stocks down from 350 million bushels down to about 300 million, which is a big, big miss. Big miss. So, I'm not surprised it didn't lower the yields, Casey. There's no reason to suggest why yields in soybeans, I think we talked about in your last show, can't be trend or above trends if we have a good August. But I think the big surprise was that they lowered those, that export demand side equation considerably. Now, one could argue they shouldn't have done that or not. However you want to slice it and dice it, according to what they are saying, even with 4 million less acres, everything's going to be fine if we have good August weather. So once again, Casey, now that the report's out of the way and we've gotten this big negative reaction in soybeans, it's all about the weather going forward. Will August deliver or not? If it does deliver, we won't have a supply problem for soybeans for the foreseeable future.
So let's talk about the weather here just a minute, because you sent out a couple of alerts talking about that. Your models are showing that basically over the next, last half of July going into August, that you should see some extreme heat and drier conditions move across from what we've seen over this last couple of 2 or 3 weeks here with this wet cycle that we've seen come through the eastern and central grain belt. So I guess talk about that a little bit, what you're seeing there.
We still think weather looks very, very good, Casey, for the next couple of weeks into like that 3rd or 4th week of July. Mm-hmm. So still see the temperatures kind of being more mild, good moisture, very, very good conditions. Corn and pollination is going to get done fairly well. Where we see the pattern changes at the very end of the month, like the last week of the month, we see a pattern change. Remember, May, June was cold, mm-hmm. epic dryness. Since late June into, let's say, mid-late July, it's been wetter, normal heat, maybe slightly below, but not as cold. And what we think we're now going to do is move to a above normal or warmer than normal temperature regime in August, and a drier pattern. Not as dry as May and June, which was epic, but a much drier pattern than we've had over the last 2 to 3 weeks. So when I look at that pattern, it means that soybeans are going to worry if we have a warm, dry pattern, what that might mean for pod setting, filling pods. And they might question whether that 52 and a half yield that the USDA is dialing in is actually going to happen. And remember, even though corn pollination, even though that pattern change would be too late to hurt corn pollination to a great degree, corn, kernel fill is going to be very, very important this year, given what I think is going to be a lower ear count because of the dry start to the crop. So even though the critical phase of pollination is going to be okay, I still think if we have a hot, dry August and we have kind of a poor kernel filling phase for corn, we can still take some bushels off. The USDA did lower their yield a little bit, Casey. Originally they were at 181. I think they came in at 177 and change. Some were looking for a little lower than that, but they did move it down a little. If we had a hot, dry August, you could probably move those bushels. You could probably take another, 2 to 4 bushels off of that if you have a hot, dry August, which would put us more in that low to mid 170s. Once again, not enough to say we're going to be in trouble. I think they came out with 2.262 billion bushel carryout for the upcoming ending stocks marketing, for the upcoming cycle season. But nonetheless, if you took 3 or 4 bushels to the acre off, you're now starting to, tighten it up a little bit here. So at the end of the day, I really feel the corn number really wasn't much of a change. I mean, I think corn's just down because soybeans was a big miss. And we talked about in your show on the last program that we did with you that the real reason to get corn back to 6 is if we have a major crop problem or a major weather problem for soybeans, and we keep that 3-to-1 ratio so that the acres in South America remain balanced. Today's report certainly threw a temporary wrench into soybeans needing to go higher. And so, it's kind of weird. I call it the rope-a-dope market. You kind of got everyone bulled up on this acreage report. They put 50 cents on, and then now they took it back off.
Right.
So,
yeah.
But now that we've done all that, Casey, now it still comes down to the weather. And if I'm correct, if our work is correct, that we are going to see a warmer, drier pattern shift later in the month into mid-late July, we will put some weather premium back on in the grain market. And so we really do think that the grain markets in aggregate are set up for a bullish turning point here late June, late July. It's kind of like the last time we mentioned this to you and to our subscribers was in late May, where we had a bullish turning point. So we think we could have some more downside. We think the weather looks pretty good. This report certainly gives the bears a reason to keep selling, and maybe we have another week or two of this, but I think we're getting pretty close to pushing on the string and we're ready to turn the corner. So if I'm a physical buyer of feed for corn, if I'm a physical buyer of meal, if I'm a physical buyer of soybeans, I want to be getting myself geared up to look to buy grains near the end of the month. I think that's going to be a pretty good place to get some upside protection on.
Right on. Okay. All right. So let's talk about demand just here a little bit, because that's one of the other elephants in the room that you hear people talk about it, but no one's really addressing it because the weather market that we've seen so far has kind of dominated the news. But I guess as you're looking at demand, from what little I can tell about this and my little bit of expertise into this this realm of marketing and stuff, the demand side of this equation is really in a really bad way. So I guess, Shawn, looking at this, even if we do have a short crop this year, I mean, is it almost right sizing it for demand that we see out there right now?
Well, remember, corn is primarily fed to animals.
Mm-hmm.
If you don't have the animals to feed, you don't have the demand for corn, and there's really not much you can do about that. Meaning, until you produce more cows and more hogs and more chickens and more whatever, you're not going to need more corn feed, as an example. We know the cattle animal feeding units are very, very low. We know the hog animal feeding units are low everywhere. We know that China's in no interest in buying feed as they are completing their African swine fever herd liquidation of their hog herd. The feed demand is just not going to be there. It is not going to be there. Now, it doesn't mean that if the Chinese get on the other side of their African swine fever later this year and they start rebuilding the herd, that they won't need some feed late in the year into 24. I think they will. It doesn't mean that as we start rebuilding the cattle herd, that we won't start getting some more animals. But of course, that's a long-term 18-month project. And obviously, we are seeing a rally in the hog market, but it's coming off some record losses. So I'm not, so if those higher prices, if China were to come in and buy pork from the US and provide a good reason for herd expansion, we could see some more animals. What I'm getting at, all the demand that I see potentially really coming, and I think it's late in the year forward, and progressively gets stronger as the year, as 2024 gets further along. So you're right, we're really in a tough demand spot right now. We needed a major crop problem for corn to really justify, a sustainable higher level. We are not going to have a major crop problem. We are going to have a crop that's not top end. We are going to have a crop that's going to be below trend. And all we're trying to do now, Casey, between now and let's say, September, is fine tune, 172, 175, 174, figuring out where in there, USDA says 177. None of that's going to really create a corn shortage until demand kicks up later in the season. So the way I'm looking at it, sure, if we have a warm, dry August and soybeans catch a weather worry rally, or have a major crop problem, corn could certainly go along for the ride for a little while, but there's a limitation to how much demand for corn can support higher prices. So the way we're looking at it is, if you really want to have an idea of what corn prices are going to do, you really need to focus on the soybean market, focus on the soybean price. That's where, even though demand was lowered by the USDA today, and even though we know bean meal demand is going to be off, the margin of error there with the lower acres is much more narrow. We don't need a major crop problem on soybeans to cause a problem, even with current weak demand. We just need a crop to be off, 5 to 8%. If we're off 5 to 8% on soybeans with the current weak demand and the current acres that we planted, we're going to really be short on soybeans in the United States, like extremely short. So where corn is absolutely positively no way fathomable that we can actually get ourselves into trouble, given the current supply demand equation and the fact that pollination is going to go okay, we can in fact get ourselves into a serious soybean problem. That's why I'm saying, if you want to look at what the corn market's going to do, you got to look at what the soybean market's going to do, and just look at that 3-to-1 ratio. So in order to get back to $5.50 or $6 corn, figuring a 3-to-1 ratio, you're kind of looking at
$18 beans.
You kind of need $17 to $20 beans, somewhere in that range, to get yourself in that $5.50, $6 level, and that would be a good place to sell. All things being equal, that would be a pretty good place to sell. Remember, in Brazil, they're harvesting the Safrinha second corn crop. One of the big problems in Brazil right now that's surfacing, we've already seen it on soybeans, is they've grown the crop production so rapidly in the last couple of years, they don't have the infrastructure to store it. We already saw that they had storage deficits in soybeans, and they were dumping, soybeans in the local market there with a record wide basis. The second now is happening in corn. Estimates are that maybe 40 to 45% of the corn that they produce, that they're going to harvest, they don't have a place to store it. They're going to store it outside on the ground and open prairie, it doesn't rain and rot. Now that could be a very big bull story, by the way. In the fall, if they get a lot of rain and it's uncovered and all that corn goes away that is supposed to be there, that it's not there. I mean, I remember in 2005, Casey, when we had a storage deficit, I remember walking through Nebraska, your lovely state, and piles of corn. Couldn't see the sun. There was piles going on the ground with a tarp over it because we didn't have enough storage, because we had so much corn at that time, and we hadn't built up the infrastructure. And of course, a lot of that corn, did get spoiled and sprouted and had all kinds of aflatoxin and all that kind of stuff. So something to keep an eye on later in the year. But for right now, that wicked, ugly nasty low basis in Brazil because they're just trying to give it away to anybody who wants it. You know, that's the situation we have right now with corn, is we have just too much of it, you know, where it can't be handled. And we probably, you know, and that isn't going to go away, you know, immediately. It's going to take time to move that. And then of course, if some of that corn, like China's corn, turns out to be too low quality, it's, you know, it's diseased, it's got all kinds of problems. And, you know, we may find out that, you know, that they don't have as much corn that's wanted by others. And so we'll just have to wait and see. But the way I am envisioning it, corn really needs soybeans to have a crop problem in August. Or else, you know, we need to keep corn prices, you know, cheap enough to revitalize that demand, to make the economics for the livestock producer look better. So he says, hey, you know what? This is penciling out. My banker's looking at this and it's penciling out for him. He will, you know, he sees the wisdom in me expanding my herd again. It's going to take a while to get there. It's going to take a while to get there. But nonetheless, now in the wheat market, it's interesting, right? Spring wheat in Russia, it's been very hot and dry. Their crop vegetative health as of this past week is, you know, very, very poor, well below normal. And it looks like they're going to have a crop 10 to 15% below what was supposed to be. If you look at the vegetative health in the northern plains and the Canadian prairies, where Russia is just as big a producer as North America is, those are the two big producers of Minneapolis spring wheat. The vegetative health is extremely poor, and hot, dry weather is expected to continue into the end of the month at a very important time for the development of yields for spring wheat. So it looks to me like if we're talking about a market that is what we call have clear and present danger of an actual shortage developing, spring wheat has the elements for that. We already know our hard red winter wheat crop, the second highest quality wheat, was terrible.
Yeah.
So the high quality part of the market, you know, that your higher quality KC wheat, your Minneapolis spring wheat, you know, if I'm looking for a bright spot for grains, a tight spot for grains, I think that's an interesting place to look. I think spring wheat could independently outperform even KC wheat. In times past, when you've had a differential, meaning much tighter spring wheat supplies versus HRW supplies, you know, we can see spring wheat trade a couple of dollars above KC wheat. I'm not projecting we're going to trade that kind of a premium, but right now if we close today where I think we're going to close, we're going to be about 55 over on spring wheat versus KC wheat. That's up from 20 over just a week ago. So we're already putting premium on. This 50-cent level on this spread is a pretty important resistance area. If we close above that, it wouldn't surprise me if we could trade spring wheat maybe $1, maybe $1.50 premium to KC wheat. So there could be a story, not a story, but I mean, there could be a fundamental story for the spring wheat market. And, you know, and that could filter into a more bullish tone to grains if we get a hot, dry weather pattern to come back as we get into the latter part of July. So that's kind of where, you know, there was hope that this report today would light another fire under grains or under soybeans at least, and it did, and it actually put the fire out. So we're essentially starting over, and weather looks pretty good for the next couple of weeks. But having said all of that, you know, where it's darkest is where you get the opportunity to buy, and where it's brightest, you get an opportunity to sell. I still feel late month is going to be an important bullish turning point and a really good opportunity for people on the buy side to consider protecting upside price risks. Because I do think that any kind of a warmer, drier pattern for August, you know, would in the least would create a significant short covering rally and a tradable rally that farmers could then selling into strength instead of selling into weakness, which is what you're supposed to do as a farmer.
Yeah, that's usually that's what they want to have happen anyway, for sure. So
that's what I want them to do. I just don't want them to be selling, you know, now like many are.
Yeah.
You know, you want to sell rallies, sell strength. You know, don't sell into a hole that typically doesn't tend to work out very well.
Yep, so very true. All right, Shawn, good stuff as usual. Folks want to reach out to you and get more information about what you're doing over at Hackett Financial. What's the best way to do that?
Our website is Hackett, Hackett, advisors.com. We also have a Twitter page at Faradix11. Plus, we have a LinkedIn page. Time to time, we put on interviews or different comments about different things that go over our weather work and capital flows work and how we make our recommendations so that people can stay in touch with what we're doing and to see if what we're doing might be of value to those watching your show.
All right, Shawn, appreciate you being on the podcast, man.
Thanks, Casey. Always a blast.
All right, buddy. We'll catch you next time. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. Go to LinkedIn at Moving Iron Podcast and check out the YouTube version of this over on the YouTube channel, which is the Moving Iron Podcast YouTube channel. Go to LinkedIn or go to Moving Iron LLC for everything Moving Iron related and all the information for the Moving Iron Summit coming up here in Nashville, Tennessee, September 11th through the 13th. So if you want to attend that, you should hurry up because it's getting full. So if you want to take advantage of that $50 discount too, send over the people at Axon will take care of that for you when you sign up. So with that, I'm Casey Seymour. It's going to be some iron, folks. Out.
Moving higher in the 21st century. Hard-working people working hard for you and me. Moving higher, time and time again. Through the years, you'll find us here.